thank you everyone for coming. So I'm going to be talking today about new shapes and structures in the solar economy and how DePIN is changing the way capital is formed and deployed with respect to the solar industry. So real quick about me, I'm a crypto OG. I've been around since 2011. I founded Coin, which hit a $3 billion market cap, and I founded Obelisk, which made custom ASICs, chips from scratch. We shipped more than $20 million of custom hardware to customers all over the world. Then I moved on to Glow, which is my latest project. Glow is a DePIN project that's in guarded beta today. We launched around December 2023, so like 8 months ago. There are 43 solar farms that are live today, and the 30-day on-chain revenue of the Glow protocol is about $350,000. So earlier this week, we were rank 1 on DePIN.ninja. That may have changed with some recent updates, but at the very least, we're one of the up-and-coming, like really big DePIN projects in the crypto space. And so before we talk too much about how Glow is shaping the solar industry, I think it's helpful to have some context about how the solar industry works. If you want to build a solar farm, the simplest thing you can do is put solar on your roof. If you have like a small to medium-sized single-family home, it's going to cost you about $25,000. And that solar is going to produce somewhere between $250 and $350 worth of electricity a month, which means you're going to have a 5 to 8 year payback period. And then the solar farm will continue to produce electricity for 20 to 40 years total. So after that 8-year payback period, you have 2 or 3 decades of just making money. And a lot of people want to put solar on their roof, but they don't have $25,000 or on bigger homes, a larger number on hand. And so they move to financing. And financing in the solar industry is actually pretty optimized. You don't have to spend any money. You don't have to take a loan. You don't have to make a mortgage. The solar industry uses the electricity revenue or the electricity that the solar farm produces as collateral. And so basically what happens is an entity called a PPA comes in. They buy the solar farm. They construct it. They own it. And then they sell you electricity revenue. And your utility bill as a homeowner shifts from you paying the utility company to you paying the PPA. And usually the PPA will do this for free. And then the bill that you pay the PPA is somewhere between $10 a month to $100 a month lower than what you're paying before. And so for this like no cost, no money down, you end up with savings. And so things get more complicated when you add Glow into the mix. So this isn't really the place to explain why, but in order to participate in Glow, you have to write a check to Glow that is equal to all of the future value of the electricity that your solar farm will be produced. So when you want to join Glow as a solar farm, an auditor will come, they'll appraise the solar farm, how much energy it's going to produce, what the value of the electricity is on your local grid, and generally the result of this net present value calculation ends up being about equal to the cost to build out. So if you want to put a solar farm on Glow, your costs are going to go up from $25,000 to $50,000. And then for participating in Glow, you get these 2 additional revenue streams. So you continue to get the $250 in savings that you were getting before each month. And then you also, on Glow today, your solar farm would be earning about 10,000 Glow tokens per month and 1,000 USDC. And so Glow's in beta. It's not super liquid, but those tokens are worth $2 each. So it's actually pretty lucrative to participate on the Glow network right now. And that's, of course, contributing to growth. If you want to do this through financing, it actually turns out to be possible most of the time. Again, the PPAs, the collateral for the loan is the electricity value, and that means they don't actually care how much the solar farm costs. They can extend the loan as long as the electricity backing it gives them comfort. And so for many homeowners, they're able to finance the Glow protocol fee as part of the financing, and they don't need any additional funding. They can just do Glow. And that'll result in less savings on their electricity bill, but then they get a bunch of Glow tokens in USDC, and crypto's kind of fun and cool. In some cases, the financing company won't give you enough loan to cover your protocol fee, and so you'll either need to put up cash yourself, or you'll need a co-investment, and there are actually funds on the Glow protocol today that work with installers and will help finance part of your protocol fee in exchange for a percentage of the rewards. So even if your electricity isn't valuable enough, or if you don't have a loan company that'll cover the protocol fee, often you can be on Glow anyway, thanks to these professional investment funds that'll help you out. So that's how things worked for a couple of months, up until 2-3 months ago. But there were some challenges, and it was like healthy and functional and growing. But the doubling the cost of building solar is material. Solar is already super capital heavy, so to increase that is difficult. And then also with this process, like if you're putting solar on your home, different parts of the grid in different parts of the country and the world have different levels of competitiveness on the Glow protocol. And so you're kind of constrained to, if your home is in, say, like Kansas, that's actually not a very good place to make money on Glow. You'd rather be in like Colorado or Utah. And then you have counterparty risk. You're giving, a $25,000 check to installers. They could run. They could, there could be shipment delays. They could destroy your roof, and so you don't know what's going on. And then finally, we had this challenge that I call the information centipede, where it's like the community was educating the solar executives, and they were educating management, who was educating salesmen, who was educating homeowners, and you're playing like this technical game of telephone through like 9 layers, and the end person, what they understand about the Glow protocol is often very like muddled and not representative of how Glow actually works. So a couple of months ago, some professionals in the Glow industry came up with this new design for getting solar onto Glow. And they said basically, instead of building solar farms and paying the protocol fee, where we end up spending half of our budget on actual infrastructure, why don't we work with installers that are already selling solar farms? We'll go to the optimal regions of the country, optimal zip codes, and work directly with installers who are already selling solar, and we'll say, offer this deal to your homeowners. If they put their home on Glow, which from the perspective of the homeowner just means signing over your carbon rights and agreeing to have auditors come on site, we'll give you $5,000 in cash. Or often it's a lot lower, often it's like $1,000 in cash. And everybody speaks cash. Nobody needs to, on the solar side, needs to understand how the Glow protocol works or what crypto is, or they don't need to have wallets. And so this greatly simplified the process of getting solar onto Glow, while simultaneously increasing returns a lot for investors, because now they don't actually have to pay for the solar installation. And so you end up with a much smaller total expense, somewhere between like $27,000 and $30,000 for the same solar farm that used to cost $50,000. And you give up that $250 to $350 a month in savings that's being owned by the homeowner and by the original PPA. But you get to keep 100% of the Glow rewards, because nobody else is even aware that crypto is happening. And so this ended up creating a bunch of advantages. It reduced counterparty risk. So unlike before, where you're writing a check and then hoping a solar farm gets built, you don't actually write the check to buy the carbon rights until the solar farm is already built. So it's eliminating risk, and it's allowing you to go and work with the installers who are in the best regions in the country. And so you get optimally located solar farms, and you like significantly reduce the education overhead. You just like, here's cash. If you don't want to sign the paper, then you don't get the cash, but like whatever. And this has had very interesting emergent effects on how solar is built. And so to understand the emergent effects, we have to break down a little bit exactly how the rewards work. So when you put a solar farm on Glow, you get Glow tokens proportional to how big your protocol fee is. And that means if you have, say, $1 million to allocate, the larger percentage of that $1 million that you can spend on protocol fee, the more tokens you're going to get in return. And so you want to basically spend as little money as possible acquiring carbon rights. And then the second thing is you earn USDC based on how many carbon credits your solar assets are producing. And so you actually want to also minimize how much protocol fee you're paying per solar farm, because then if you can stretch $1 million into, say, 50 or 60 solar farms instead of 20 solar farms, you're going to be earning 2.5 to 3 times as much USDC. And so the result of this is that CPA funds, carbon purchase agreement funds, are looking for regions of the solar grid where solar is barely viable. The best place for a CPA fund to be successful is to go to an installer that's in a region where the electricity price is so low that the financing, the PPA companies are denying, half or more of the solar farms and saying, we just don't think the electricity is valuable enough for us to fund this solar farm. The CPA fund says, look, I'll pay for $1,000, just enough of the solar farm to switch it from the financing company won't allow it to happen to now the price of the solar farm's been reduced enough that you can get financing. And because the electricity price is so low, and the electricity price is the main factor that decides how big your protocol fee is, this fund is paying a much smaller protocol fee as well for each solar farm. And the net effect of all of this is that you end up with a bunch of funds trying to deploy capital on the GLOW protocol to mine GLOW tokens, where they're entirely targeting, or they're strongly incentivized to target regions of the electrical grid that currently aren't viable for solar. And specifically, they're looking for the areas that are like on the razor's edge of like almost viable but not quite. And so the result is that because of GLOW, there are sales teams that are going and building solar in places that without GLOW wouldn't be having solar today. And so at the end of the day, GLOW is a carbon project. The goal is to roll out as much solar as possible. A lot of the solar industry is plenty profitable and doesn't need help. And the natural incentives of GLOW and the natural incentives of this emergent CPA funding process results in all of the money being spent on solar farms that are, or most of the money being spent on solar farms that genuinely couldn't exist without an extra subsidy. And so that makes GLOW one of the most targeted and highest value carbon credits in the solar ecosystem. And so I have plenty more to say, but not enough time to say it. So I'm going to have to cut myself off there and say thank you for listening.